What if the U.S. lost its grip on $6.1 trillion in global trade overnight, blindsided with no warning, no sanctions, no tariffs, no military clash? On May 26, 2025, China quietly pulled the plug, sidelining the U.S. dollar and steering the world toward yuan-based settlements. Their message was clear. Trade happens, but only on our terms. While Washington slapped tariffs as high as 145%, Beijing built a parallel financial system, already reshaping global markets for oil, steel, and tech. Wall Street's worst nightmare is unfolding, yet most Americans remain unaware. If you're ready to grasp the biggest economic shift of our time, hit like, subscribe, and let's dive in. Imagine waking up on May 26, 2025, to a world where China, without firing a single shot, reshapes global trade. No loud declarations, just a quiet directive to its banks, slash dollar-based transactions, and pivot to the yuan. Overnight, countries start pricing oil, steel, and machinery in yuan, bypassing the U.S. dollar entirely. While U.S. officials demand China play by their rules, Beijing draws a firm line. We'll trade, but only on our terms. This isn't a tariff spat. It's a financial revolution, and America's hold on the global economy is slipping fast. Here's how it unfolded. While Washington pressed China to scale back manufacturing and boost domestic consumption, Beijing rewrote the playbook. The People's Bank of China hiked the minimum yuan ratio in cross-border deals from 25% to 40%, sidelining the dollar in transactions worth over $6.1 trillion annually. This was no symbolic move. Bloomberg reports that Chinese banks failing to comply face severe regulatory penalties, effectively locking them out of capital markets. Goldman Sachs estimates that every 1% rise in the yuan's value could lift Chinese stocks by 3%, signaling a massive financial shift already in motion. But China didn't stop there. At the Global Finance Forum, U.S. Treasury Secretary Scott Bessent accused Beijing of destabilizing trade and urged a shift toward consumption. China's response? A bold, revamped, made-in-China strategy, doubling down on AI, robotics, and semiconductors. Manufacturing, which fuels 25% of China's GDP, is non-negotiable, Beijing declared. Instead of choosing between producing less or consuming more, China's plan is to dominate both and price that growth in yuan, eroding Washington's grip on global trade. What does this mean for markets banking on dollar dominance? This isn't a fleeting protest, it's a structural overhaul. By shifting trade to the yuan, China shields itself from U.S. sanctions while pulling global capital into its orbit. In Q1 2025, yuan settlements surged to 30% of goods trade, up from under 20% 2 years ago, according to PBOC Governor Pan Gongsheng. Reuters projects that moving another 10%, roughly $610 billion, into yuan could spike demand for Chinese assets by 12%. As yuan trade grows, fewer dollars flow into U.S. treasuries, draining liquidity from American bond markets. The fallout? Weaker dollar demand, tighter capital for Wall Street, and foreign banks scrambling to hedge in yuan. China's real advantage? Who's buying in, and who's tuning out? Washington. Picture yourself in a Johannesburg electronics shop. You're picking up a Chinese-made generator. It's well-built, affordable, and, surprisingly, it's priced not in U.S. dollars, but in Chinese yuan. That's not a hypothetical. It's the new reality. In the first quarter of 2025, BRICS trade with China hit 1.49 trillion yuan, roughly $209.7 billion, up 11.3% from the same period last year, according to Chinese customs data. Countries like South Africa, Iran, and Brazil are increasingly doing business in local currencies or yuan, sidestepping the dollar altogether. In the background, global trade is being reshaped. Former President Trump's new wave of tariffs, which now reach as high as 145%, is pushing traditional trading partners to look elsewhere. And as payment systems shift, pricing follows, making the dollar not just politically fraught, but increasingly inefficient. So, if buyers are moving away from the dollar, where do exporters place their bets? While U.S. officials double down on a Fortress America strategy, China is doing the opposite. building and expanding trade network with enthusiastic partners. Chinese exports to Brazil jumped 25.7% in Q1 2025, while imports surged 30.1%, setting new records in bilateral trade. Trade with Russia also grew, especially in energy and machinery, thanks to more predictable pricing, fewer political strings, and contracts denominated in yuan, shielding buyers from U.S. sanctions. Liu Daoyang of China's Customs Service says BRICS now accounts for 20% of global goods trade, further accelerating the shift away from the dollar. Here's the twist. Washington's sanctions, meant to isolate Beijing, are actually drawing more countries into China's financial orbit. So what happens if the dollar loses its status as the world's go-to currency? And who loses the most? When Trump ratcheted up tariffs in early 2025, the move was billed as economic self-defense. But instead of weakening China, it accelerated their global pivot. According to Bloomberg, Chinese heavy machinery exports soared 18.4% in Q1, despite ongoing challenges in China's domestic real estate market. Major state-backed firms like SANY and XCMG redirected idle capacity from stalled home projects to international markets, offering prices up to 50% below global competitors. The Wall Street Journal reported record-high shipments of construction vehicles to Africa and Southeast Asia, with many contracts priced in yuan, neatly avoiding U.S. tariffs. With scale and state backing, China didn't just survive the pressure, it turned it into leverage. But how far can that pricing power stretch if Beijing also controls the currency? In April 2025, China settled over 40% of its BRICS trade in yuan, up from 29% the year before, according to central bank data. That's more than growth. It's momentum. New BRICS members like the UAE and Egypt are signing major infrastructure deals in yuan, bypassing the U.S. financial system entirely. Even Saudi Arabia is reportedly considering pricing oil contracts in Chinese yuan, according to a leaked draft cited by Reuters. This isn't just about cutting costs. For many countries, it's about building resilience, shielding their economies from the political and economic fallout of U.S. sanctions. The dollar's dominance isn't disappearing overnight, but the balance is shifting, and fast. Who really holds the power in global trade? Here's the big question. If Beijing is offering faster settlements, fewer restrictions, and zero political baggage, who really holds the upper hand in global trade? Drop your thoughts in the comments, because what's coming next might tilt the scales even further. China isn't challenging the dollar with confrontation, it's quietly building an entire parallel system, and it's working. According to the Financial Times, over 60 countries are now using China's cross-border interbank payment system, or CIPS. Think of it as an alternative to SWIFT, processing international payments in yuan across Asia, Africa, and parts of Europe. By March 2025, transaction volumes surged 27% year-over-year. Why does that matter? CIPS shields China's partners from dollar volatility, U.S. sanctions, and political pressure. At the same time, China's digital yuan is expanding, now live in 14 new trade zones. Settlements are faster. Tracking? Nearly impossible for Western institutions. This isn't a protest, it's strategic infrastructure, a deliberate move to make the dollar optional. Every transaction that skips the dollar isn't just a workaround, it's a signal. Not that countries are choosing sides, but that the dollar's dominance can be replaced, not with headlines, but with alternatives. So how vulnerable is Wall Street if this keeps accelerating? The entire U.S. financial system rests on global demand for dollars. But if China brings more trade into the yuan's orbit, capital will follow. Goldman Sachs estimates that just a 10% rise in yuan-denominated trade could cut foreign demand for U.S. treasuries by $210 billion a year. That's not speculation. That's a slow, measurable bleed. Bloomberg's bond tracker already shows a 12% drop in U.S. debt held by Asian institutions in Q1 2025. And central banks in countries like Indonesia, South Africa, and Iran are steadily boosting their yuan reserves, according to IMF data. This isn't just about currency, it's about trust. And whether the U.S. financial system is still seen as reliable, neutral, and stable. Because if dollar reserves no longer guarantee access or safety, global capital will look elsewhere. And China? China isn't waiting to be invited to the top table. It's building its own table and rewriting the guest list. From dictating trade terms to rerouting capital flows, China's de-dollarization playbook is already in motion. But here's the twist. If removing the dollar was just phase 1, what's phase 2? Leaked policy memos suggest that China may soon tie its digital currency directly to trade pricing, locking in buyers and bypassing foreign exchange markets altogether. That's not just a shift in payments, that's global financial engineering. So, if you thought this was the big pivot, think again. The real transformation? It's still coming. What's your take on all this? Let us know in the comments. And if you found this breakdown useful, hit that like button and subscribe for more insights like this. See you next one. Thanks for watching.